Blue Chip Bulletin. Financial market updates and insights.
So Target's latest earnings report just dropped, and honestly, it paints a picture of a company at a huge crossroads. We're seeing this really fascinating mix of good news and bad, but underneath it all is a bold, multi-billion-dollar plan to try and win back both shoppers and investors. Okay, let's dive right into this and see if the bullseye is actually back in focus.
Here's what we're going to cover. First, we'll break down this quarter of contradictions that has everyone talking. Then, we'll figure out exactly why sales have been slumping. After that, we'll unpack the massive $5 billion bet Target is making on its future. We'll also see how they stack up against their biggest rival. And finally, we'll get Wall Street's take on whether this stock is a buy, a sell, or just a hold.
All right, let's get into the latest numbers. And right off the bat, you can see why investors are probably feeling a little bit of whiplash. Because on one hand, there's a really good reason to celebrate. Their profits were strong. But on the other hand, there are some pretty serious warning signs flashing when it comes to sales. Let's start with the good news, the upside surprise. Wall Street was only expecting earnings of about $2.17 per share, but Target came in hot, delivering $2.44. That's a solid beat, over 12%. It tells us the company is getting way better at managing its costs and protecting its profit margins. This is the good part of the story. But, and this is a big but, strong profits don't tell the whole story. While the bottom line looks great, their top-line sales actually fell by 1.5% compared to last year, coming in at $30.45 billion. So here's the really crucial point. Fewer dollars are actually being spent at Target, even if the company is squeezing more profit out of each sale. And if we zoom out a bit, you can see the long-term challenge. This isn't just a one-quarter problem. The stock is trading at roughly half of its all-time high. So that tells us that despite a recent profit beat, investors have been worried for a while about the company's fundamental growth and its ability to consistently get shoppers in the door. So, if sales are down, the big question is, why? To figure that out, we need to basically look inside the shopping cart and see what people are buying, and maybe more importantly, what they are not buying. Yeah, this breakdown of what people are actually buying is incredibly telling. The growth areas are all in essentials, and those affordable little luxuries. Food and beverage, beauty, and even toys saw some positive movement. But look where the money is disappearing from. Shoppers are pulling back hard on the very things Target is known for, like apparel and home furnishings. And this all points to what Target's own management is calling the choiceful consumer. It makes sense, right? People are stretching their budgets, they're focusing on what they need, and when they do buy the non-essentials, they're hunting for value. That treat-yourself impulse that drove so many sales for years has kind of been replaced by some careful calculation. So, what's Target's big plan to fix this? Well, this brings us to their massive new strategy. Faced with these challenges, the new CEO, Michael Fiddelke, isn't just tweaking a few things here and there. Nope, he's launching a really ambitious and pretty expensive plan for a full-blown comeback. You can hear it in Fiddelke's own words. He's framing this as way more than just a recovery. When he says the team is focused on writing Target's next chapter of growth, he's signaling a fundamental shift in their strategy, not just a plan to get back to the old way of doing things. And that next chapter, well, it comes with a massive price tag, $5 billion in capital expenditures planned for fiscal 2026. And just to put that into perspective for you, that's a $1 billion increase from what they're spending right now. So yeah, this isn't just routine maintenance, this is a huge bet on reinvention. So where is all that money going? Well, it's being channeled into two main areas. First, a major overhaul of the physical store experience. And second, a really significant push to advance their technology and digital capabilities. On the storefront, they're planning the biggest redesign in a decade. This means remodeling stores to be more inspiring and just easier to shop, especially in those categories that have been struggling, like home and baby. They're also opening new, larger stores, which are already doing really well. The goal here is to bring back that feeling of discovery, that Tarzhay magic that's maybe been missing. And on the tech side, it's all about getting smarter and faster. They're using machine learning to make sure popular items are actually on the shelves, which has already improved in-stock rates. They're also rolling out AI tools with cool names like Trend Brain to spot what's hot, and even using AI-generated synthetic audiences, which are basically virtual focus groups, to test marketing campaigns before they launch. It's a full-stack tech upgrade designed to make them a much sharper retailer. Now, a $5 billion plan sounds really impressive, but, it doesn't exist in a vacuum. Target is in a brutal race, so let's see how this new strategy really stacks up against its biggest rival. Okay, putting Target head-to-head with its arch-rival Walmart really shows you the scale of the challenge. I mean, look at this. In the fourth quarter, Walmart's foot traffic was up over 2%, while Target's was down 2%. Walmart's sales grew over 5%, Target's shrank. This single data point shows exactly why that big investment in the store experience is so absolutely critical. They are losing the battle for shoppers right now.
So we have the problem, and we have the proposed $5 billion solution. This brings us to the final and most important question. After weighing all of this, what's the verdict from Wall Street?
Well, despite the bold turnaround plan, the reaction from Wall Street is cautious. Over half of the analysts who cover the company have a hold rating on the stock. This signals a real wait-and-see attitude. They're intrigued by the plan for sure, but they're not yet convinced it's going to translate into consistent growth. There's a lot of uncertainty pressed in here.
But here's where it gets a little more optimistic. The current price is hovering around $114. However, multiple valuation models see some potential upside. The Investing Pro Fair Value model pegs it a bit higher at $118, while analysts at UBS have set a price target of $130. So, the key takeaway is, if the company can actually execute this turnaround, there appears to be room for the stock to run.
And that leaves us with the ultimate question. Target has a new CEO, a really clear diagnosis of its problems, and a massive $5 billion plan to fix them. So, is this the turning point that finally gets the stock back on track? Or are the deep-seated issues with consumer spending and competition just too big to overcome? For now, it seems like both shoppers and Wall Street are watching very, very closely.